Welcome to the Big Biz Show. Taking care of business. You want fast-talking, hard-hitting discussions on business and finance? Maybe with a barroom slant and some really salty peanuts? We're not counting calories. We're counting cash. Before we get to the man with the financial plan, meet the money team. Costa, Mary, now Captain Finance himself, Sully.
Wherever you're listening, we welcome you to the Big Biz Show. We are inside the Loftrun Hunter Studios in Southern California. And as we like to say around these here parts,
we never
big old howdy to you. Woo! It sings, as they say in the music business.
During the financial meltdown, personal financial meltdown the last couple of years, under that administration, we saw a stock market that went through the roof. Mm-hmm. Now, are we in a bubble here? I mean, I mean, it's because
love the conversation, right?
Right.
So one, you have the aspect of all the money printing, right? I mean, we have Fed going back to zero rates, like the universe is about to collapse. At the same time, the government spends trillions of dollars, PPP loans and the checks to everybody. So you have a bunch more dollars in the system. That's going to throw valuations sky high. So if there's only $1 billion in the world and Apple stock is worth $100 a share, and all of a sudden there's now $4 billion in the world because the money printers just were let loose, then you're gonna have $400 Apple stock. And so that happens to valuations all the time.
Sure. Yeah. And now it doesn't mean though. See, the valuation is basically the share price times the outstanding shares. Mm-hmm. Now, that means that's what your company's worth, but not necessarily sometimes. And I keep on using Starbucks as an example. Starbucks at one point was trading, 80% below their book value at some point. And they had a billion stores still. And you realize, look, it was just an undervalued company that got itself in some financing.
The Oracle of Omaha made his bones off finding companies.
Exactly, which is the point here, right? Yeah. Is you have to go with what you like, but you have to go with longevity versus maybe going granular on who's in the lunchroom, what are their earnings. What are we looking at here in terms of valuations in this new kind of regime?
So a good way of measuring a stock is its price to earnings multiple. The price of the stock divided by the earnings that the company makes, the money that the company produces.
Now, keep in mind, this is not price to revenue.
No,
this is price to earnings.
Earnings.
And this is important because you can manipulate price to earnings like they did back in the 80s and 90s by firing people and reducing your payroll. So your earnings went up, right?
Yeah, you can be very short-termist about it, but the market gets hot, it gets excited, and as you can see in the chart, there are periods of time when we're valuing companies at levels, a basic restaurant that normally trades at maybe 20 times its earnings, trades for 50 times its earnings. So we see a couple of examples of how the markets get overzealous, and you see the situation that we're in now in 2025, and it looks pretty stark to me. I mean, this is just one metric that shows how overvalued the market.
But I want you to see something on this chart, folks, and if you can bring it up again. Go back to 1929. If you're just a technician, technical technician, and you go back and you see the very left of the chart before you see 1929, you see every time there's a peak, there's a valley, and there's a lower peak. So each new peak each new high is lower than the previous high. Each new low is lower than the previous low is what you're seeing before you see the 1929 high. Now, that's a technical indicator that will tell you that it's probably a dog without a bone, and it's going downhill. Another technical indicator that you see all through 29, 65, 1999 is what you see as a double top pattern. Yep. You see a top in 1929, and then a drop, and then another top, and then guess what happens? Same thing happens in a very short period in 65, same thing happened in a very longer period in 1999. Yeah, those double tops and double bottoms, well, I'll tell you what, you need to take a look at three things. You need to take a look at who's in the lunchroom, fundamentals. You need to take a look at what's going on the street, what's the news say, but you got to look at technical analysis also. Because if most people buy a stock at 100, and that stock goes down to 80, and hope against hope they don't get rid of it. What do you think they're going to do when it goes to 100? They're going to sell it. So that's predictive technology.
I got out of that.
So you can see what people are going to do. More from that coming up here. Howard.
Exactly right.
All right. We're overvalued.
Howie Font is our Big Biz Show market analyst. Always better when he's in studio, not in the Big Apple. Keep it here. Lots more to come with him as the Big Biz Show rolls on.
Welcome to the Big Biz Show. Taking care of business. You want fast-talking, hard-hitting discussions on business and finance? Maybe with a barroom slant and some really salty peanuts? We're not counting calories. We're counting cash. Before we get to the man with the financial plan, meet the money team. Costa, Mary, now Captain Finance himself, Sully.
Hey there, live from the Loft 100 studios here in sunny San Diego, California. Big Biz Show is on the air. Of course, thankfully, it's just me and Mary. Mike Costa's here. I think we're better for it. The Day Trader Trio, and as we all like to say, welcome to the Big Biz Show.
Are we not allowed to say it?
Let's get straight to Howie Font, our analyst in New York, here to talk about, do any of us matter, Wall Street versus Main Street? Because, we all talk about how emotions run the market, Howie. But in reality, institutional investors run the market, right? I mean, our $500 worth of Robinhood investing, or listen, even your $500,000 worth of, if you're a total asset base, is not really moving the market. Institutional investors are, which is a little bit scary.
It's true. I once knew a guy at one of the large banks. He would say, a good business sells to the classes or to the masses. And I realized that we on the show, we always say it as a truism, that there's a difference between the economy and the stock market, difference between Wall Street and Main Street. And I realized we kind of hadn't gone through the numbers. So that's kind of what I wanted to do today. Talk
about that, because Labor Department survey now shows that the top 10% of earners account for about 40 to 45% of consumer spending. Labor share of economic output has decreased from 64% down to 58% from 1980 to today. Extrapolate those numbers for us.
Yeah, so that labor share number means, what actual people and their wages are accounting for the output of the economy. The rest of it, you might be asking, is capital. So if you have a factory, the workers of the factory account for, in the 80s, it was 64% of the output. Now it's 58% of the output. The stuff in the factory did the rest. So it means that we're using more robots, or software can get more stuff done for us, and those are things that aren't from labor. So we're making stuff with less human input, and the consumer number means only the top richest people are consuming it. So we don't even need to worry about selling, kind of like the old Walmart model. You want to sell to everybody and you want to sell low price. You don't need to do that anymore. You can kind of focus on the higher tiers.
The thing that is interesting to me is where the financial institutions come into this play, because I think that we think we're bigger than our britches here as individual investors, and I think there's some eye-opening to be done here. Talk about that.
Yeah, so we used to have lots of mom and pop stores, or a plumber had their own business, the HVAC guy had their own business. You get things wrapped in so many financial wrappers now. A private equity comes and owns the group of, let's say, 10 HVAC companies, and then a pension will take out a piece of that. That pension will wrap itself up with another pension, and they'll
as an investment. When you say take out, as an investment.
As an investment, that's right. So what I mean is we've financialized every level, and there's fees associated with all of that. So these large financial institutions, the asset managers, they account for a huge portion of the economy, and it's kind of like double counting, because we say there's $200 million in the economy, just as an example. 100 million of it is in HVAC companies. The other 100 million is in all the companies that own all of the HVAC companies. This starts to look like a house of cards.
So if you do, so this is what it means. It's the same thing we do all the time. If you do not have some money at risk, if you don't invest, that means you're going to be left behind. So, you go to rule of 70. You go to rule of 72s. You can do any other number of financial modeling and realize that even if you are an investor, if you got out every single time in the last 10 downturns and then got back in when you thought it was safe, you probably have an average of about a 6% return versus what, Howie, 10, 11, 12, 13% return overall?
Yeah, I mean, for the last 15 years, it's been more like 13.
Yeah, because you can't get out here and time, because you're missing those little eeks are really what gets you there, and that's why you have to remain at risk. Now, there's certain tools you can use, like we talked about before with the put, but there's also a trailing stop you can use for an individual stock trader. The best thing you can do is get a money manager. Like I'll tell you, my daughter Delaney and her husband Armani are two young people in their just 30 years old, with enough sense to not be in debt and to sock something, pay themselves first every single week. And they don't have a huge nest egg, but they're trying to buy a house next year. And I happen to have a money manager. Most investors don't realize that they probably have a family member that has a money manager that you can hitch your cart to, because you don't have to have the minimums like most money managers have, and somebody else can do it for you. You can set it and forget it, right, Howie?
Can I ask a question? A dumb question, probably. You know me, I'm good at those.
No such thing as dumb questions,
people.
Just dumb people that ask them.
That's me. So that's why you have me here. So when you're talking about, like you just said, the economy will leave you behind if you don't invest. This is a dumb question, but is that just, could be considered my 401k and my IRA that I have?
You're investing.
Okay, so you don't need to be day trading and doing all the crazy forget about it.
100%.
Yeah, what it means is you can't put your head in the sand and not do anything.
Right,
I think it's what you're saying, right, Howie?
Yeah. You can't not do anything, and kind of what might be a little bit different from people's expectation is it used to be your income was enough to kind of support you through. Your income's going to grow over time. You're going to stay at one employer, all that kind of thing. That's not the case anymore. You need to invest along with your income. Your money needs to work while you're working to keep up in an economy that's built for capital, basically. I mean, that's what these numbers today are kind of describing. Capital grows faster than your labor output. You need to be using both. Yeah.
If you take the number 72 and multiply it by the average rate of return, you're going to figure out how long it will take for your investment to double. If you take the number 72 and divide it by the interest rate, it'll tell you how long it will take your money or your purchasing power to be cut in half. So if you think about those two,
I don't want to do any of those.
No, you do.
No, don't do the last one.
But look, your feeling. It's useful because of the simplicity of it all, and it's a versatile number, the rule of 72. But I can tell you the moral of the story, Howie, which you've been talking about for years now with us, and that is the thing is that you have to stay. We say at risk. People hate that word, but when you invest in anything, you invest in time. You could be wasting your time. You invest in a private deal, you could be wasting your money. You invest in a stock, you could be. But if you do it intelligently, there's a reason why the Dow Jones is in the positive and not in the negative since the history of the Dow Jones stock market. So it means over time, it always goes this way eventually. Now, if you take snapshot in time, okay, I lost $50,000 today in the market. No, you didn't, unless you sold it, right? When you're done and retiring, you're not going to lay all the money on the kitchen table or on the bed and roll in it. It's still going to be working for you if you do it. But the real moral here, though, is that middle class growth, if it's based on income alone, is never going to happen. And I don't think it ever could happen except for one snapshot in time in 1958. I think you always had to put your money to work for you somewhere, correct?
Yeah, I think that's right. I think spending money or even holding a savings just in cash is an investment choice. You might just not know enough to make a different choice, or you might have a view that says that's the best thing, but it's a choice and you have to look at all of your options. You and I are kind of humbly saying to the audience, please consider investing your first $10,000 in an index fund, see the rule of 72 and all that. I mean, it's kind of the point I was making before, and it's what I want people to have in their heads every time they watch and we say difference between Wall Street and Main Street. Use your capital. That's the kind of economy we have. It's got to stay at work just as much as you are.
Hey, I've got
the data says that. Yeah.
I got a question about the shutdown. Rumors swirling that the shutdown could be over here in the next couple of days. If it isn't, it's going past the holidays.
I have flights to take, so I really hope that it.
Oh, Mary, I'm so sorry. The FAA announced that it's asking some top 40-some airports to reduce air traffic by 10%.
I heard.
Unprecedented move. Really, really terrible. I can't believe it's going on this long. And, the week is mostly done, Sully. I think this probably does go through Thanksgiving, which is kind of insane.
You think if it's not this week? Honestly, I mean, it's because of they go to intercession here pretty soon. Is that the idea? As everybody takes off?
Yeah, I think there's not. I think if nothing changes this week or early next week, then there's not going to be.
What's the likelihood of it? I mean, like, what's the pinch point right now?
Yeah, so the pinch point right now is the healthcare subsidies were always going to expire in December. That's the next thing that will change, right? So we ran out of money for SNAP. The food assistance program, a lot of government agencies are running out of their contingency funds and things like that. That was all known. But what's going to change the equation is what happens when the currently existing subsidies that are still being funded, when that deadline hits in the first week of December, then people will start feeling even more pain.
Yeah, well, I want to see this thing end soon because...
I know. I didn't mean to make light of my flight because a lot of kids are not getting fed and a lot of people are...
flights are going to get more expensive if they're...
It paralyzes the economy. The flight matters. It's the biggest travel day of the year. I think you're right, Mary.
Big Biz Show.
I got to figure it out.
Thanks, Hal. Appreciate that. More to come. See you in a minute. Having a great day on the Big Biz Show. Thank you, everybody who is watching and listening for being along for this ride. Day Trader Trio is always along for the ride. Of course, back here at the bar, it is Costa, it is Maribert Godwin, and it is Sully. Great to have you along today. We are brought to you by Prudential. Let Prudential be your rock for retirement. Also brought to you by Bayer Advanced. Better science, better results. I'm about to sneeze. Starbucks coffee, because I just snorted a bunch of Starbucks.
I thought it was dramatic effect.
Sneeze. Oh, you thought it was a pause?
Yeah.
Embracing the pause. Yeah. And of course, Taylor Guitars. A credit risk monitor company typically sort of specializes in assessing and monitoring financial health and bankruptcy. Mm-hmm. Michael Flum is the Chief Executive Officer and President of CreditRiskMonitor.com. They are publicly traded. What's the stock? CRMZ. And he's here talking to us today about tariffs, geopolitical tensions. Oh boy. Commercial bankruptcies driving supply chain concerns globally, and basically their supply chain monitor is kind of helps procurement and supply professionals, as well as a bunch of other things that they look at, because this is about financial risk, isn't it, Michael? Your whole game is financial risk, is it not?
It is. It's certainly our niche, and thanks again for having me on. It's good to be back. So
I have a question for you, because if I look at some of the data that you shared with me, let's talk about, we always hear about the student loan forgiveness, which is I can't remember, 72 trillion or 27 trillion. I get the numbers mixed up. Either way, it's the exact same amount of car debt. And if you're going to forgive anything, forgive car debt. Yeah. Because it affects more people. I mean, 20% of people go to college, 25% of those use student loans. That affects a very small portion. If you're going to forgive car loans, because that gets people to work. Same thing. However, household budgets are being strained by car loans right now. And an average car loan is, I shouldn't say average, but 20% of the customers have 7-year car loans right now, which is crazy. And that equals, I know Michael is right in this, he's ready to hit this one out of the park. That equals default rates. And that means that you've got companies that buy paper, right? Let me give you a little teasable moment here. During the mortgage crisis, Great Recession, we were getting loans because we fogged up a mirror, and everybody's getting a loan. They would take that loan, so now I owe you $100,000, and they'd sell it for $99,000 in the secondary market. So they were selling paper. They amassed a bunch of loans and sell it to the next guy, who sold it to the next guy, creating a derivative all the way along that blew up. Same thing sort of happens in the auto loan market. It's not as egregious. However, these companies that are buying paper and are the big companies like Tricolor and First Brands and so on and so forth, those guys are now risky. Does this go all the way back to the fact that it's leaning on people's budgets, Mike? I know it's a long-winded question, but is that kind of how it works?
I think it's a lot of factors. I mean, quite honestly, listen, it's a feedback loop from, ZIRP, basically going forward now. A lot of these car loans were initially originated, during the pandemic, where you had really low rates, but people are rolling off of those leases and realizing they still need a car, right? I mean, I think the bigger issue for me on some of this is that, car loans in themselves actually are a precursor to some other issues that are going on macroeconomically with the market. Like, if you start to default on your car and that's repossessed, and I don't know the stats off the top of my head, but I was reading an article about, 2 days ago about repo, within the car, within cars is like up, 20% or something like that year over year. So it's dramatically impacting people's ability to get to work. right?
Yeah,
and now you have a different you can't work, you can't get paid, which means you can't create demand. I mean, we're still mostly a consumption-driven, GDP economy. So I have concerns about what that does long-term from a macro perspective for GDP.
Mike, not to interrupt, I know Costa's got a question. Is this just in the subprime auto market area, or is this all A paper all the way down to triple B?
I mean, again, I would say it's probably right now more of a contagion, in fact, in subprime. But it's the subprime issue is in itself kind of a canary in the coal mine. Not to use that phrase every time I'm on here, but basically, this is an off-balance sheet financing problem, and it's part of the private credit market in general. You just have a lot of people who believe they have securitized, credit agreements that oftentimes are very opaque without a whole lot of due diligence, and therefore there's a lot of different overlapping claims for collateral within that. So you might think you're securitized, but if there's 4 or 5 other lenders who are claiming the same asset, you're going to have a problem. I mean, that's why all these are ending up in fraud.
Yeah.
Right?
True. No, true. And that's the piece of this that caused the subprime market of the mortgages. Now, look, I know it's not, but still, we're talking billions of dollars here. It's a lot of money.
Michael Flum is the CEO, president, CreditRiskMonitor.com, incorporated, their ticker symbol CRMZ. So, Michael, would you say that everything you're looking at, are we looking at a bubble that's going to pop again? I'm not going to say it's going to be like the .com bubble or the mortgage bubble in 2008, but is that trajectory? Is that the path we're on?
I mean, listen, I would love to tell you that I know the forecasting. I can tell you that there's a lot of debt out there that, in my mind, is underwater, right? And that's just talking about the, subprime auto market or ABS or that. I mean, quite honestly, if you issued, credits at 0% rates or negative interest rates or even low rates now, like when you mark that, it's underwater right now. So there's a serious issue in terms of what they're being carried at versus what they're really worth now. I don't think anyone wants to.
I'm not so concerned of a bubble affecting the whole economy. I'm concerned of the open air indicator that it's showing us right now that it's a problem now, because the open air indicator is people can't afford their car loans right now because for whatever reason. My problem is the damage has already been done. You can't stuff the genie back in the bottle. It's now on top of that, if there was a big topple, that would but I don't think it's a big enough piece of it.
I mean, Sully, to your point, though, that's the thing, right? It's not just the ABS market for autos that you're hearing it into. It's CPG, right? I mean, I think P&G just came out with guidance change because people are stretching. Yeah. They're mixing water into soap now.
Well, and of course, Fed's cutting short-term interest rates, and that's for the second time in a row. That's sort of a key marker that maybe we're finally done with the inflationary period and we're going into better times. But boy, nick a time party of one, your table's ready, right? Because it happened yesterday.
Well, hey, Mike, can you tell us how AI and machine learning is affecting what you do?
Well, I mean, we've been using AI for a long time with machine learning for our credit models. So, actually part of the reason we sent over some of those talking points for you guys is that our PACE analytic, called the PACE score, it's a private company bankruptcy analytic, captured both, Tricolor and First Brands, which are the two kind of largest private company bankruptcies we've had in the last month or so, month and a half. But both of those were tracking as high risk, like very low scores, high risk of bankruptcy for over a year. So it's not like this is something that hasn't been identified. And what's interesting about it is because a lot of these issues in these opaque markets for private credit often rely on off-balance sheet arrangements, like supply chain finance, factoring, et cetera. They're very hard to pick up using financial instruments, right? So we focus a lot on financial risk. And obviously, if you can get the statements, that's a really big deal. But the PACE analytic itself actually runs off of trade payment information as well as federal tax liens and some firmographics. So it's able to pick up these issues, even though they're not necessarily reflected in any publicly available financial statements. So, I think there's a lot of interesting thought that you can do with AI for these types of situations. Certainly, our PACE score is one of them. We also view it as just generally getting more information from news. So there's a ton of things with AI, but I think the conversational AI is going to be a big impactor on this, because all of a sudden now you can ask the question of, hey, you know what, I got these many businesses that I'm worried about as far as counterparty. Show me what I need.
I need more of Michael Flum
Yes, we do.
You need to get in San Diego so we can steal you for a whole hour, buddy.
He is the CEO, president of CreditRiskMonitor.com, Inc., of course, ticker symbol CRMZ. Speaking of C, we're going to see you later. Loft 100 Studios, the Big Biz Show, and our affiliates and our hosts are not registered investment advisors or broker-dealers.
Our show hosts make no commitment that the purchase of securities of companies profiled or otherwise mentioned in our programming
are suitable or advisable for any person, or that an investment in such securities will be profitable in general.
Given the nature of the company's profile and the lack of an active trading market for the securities, investing is highly speculative and carries a certain high degree of risk.
We profile selected publicly traded and privately held companies on our program.
Most of these companies that we profile have provided compensation to Loft 100 Studios and its hosts for the profile coverage.
From time to time, we sell shares of the companies profiled in the open market that we receive as compensation for coverage of client companies.
But never sell stocks if we are speaking about interviewing or covering a public company who has paid compensation.
Specific questions on compensation can be obtained by contacting producer at sullyandgroup.com.
Listeners should verify all claims and do their own due diligence before investing in any securities mentioned on this program.
Investing in securities is speculative and carries a high degree of risk.
We encourage our investors to invest carefully and read the investor information available at the websites on the
Securities and Exchange Commission at sec.gov and or the Financial Industry Regulatory Authority, FINRA, at www.finra.org.
I like it.
Hey, is that a rescue plane?
Well, here we go again. Big Biz Show, bigbizshow.com. That's 80 million TV homes, several TV networks all over the interweb. Every podcast place you can find, every terrestrial outlet, and of course, American Forces Radio Network as well. Great to have you along. I'm Sully. That's Mary Burt Godwin. And of course, Mike Costa is nowhere to be found. Last time I heard, he was not feeling good.
Not feeling good.
I don't know why. I'm not sure. Was last night a big night?
Probably the Funyun.
Oh, yeah, I could say that. Hey, one of my favorite people that I've met just recently is a guy named Levell Malloy. He is the CEO and founder of Bragg House. And Mary will tell you, and I don't think Levell, I've never ever said this to Levell off the air, but every time he's out of the air, like, man, we all talk when the cameras go off, like, that guy's smart.
Smart.
This guy has created, along with a partner, the #1 home for the casual college gamer. Now, can you imagine the numbers when you hear college gamer? A certain age group. And what I've talked him into do, I think, is to really create a series for us on this thing that he calls a cultural capital playbook. He talks about bridging culture and capital together.
It's genius.
Meaning that he's going to deploy all of these masses and turn it into money. Once again, he joins us. Levell, what's up, man? Good to see you.
Oh, it's good to be back. Hey, guys. How you doing?
Hey, so look at culture was forever, to use your parlance, a soft asset. It wasn't even a metric before, because I mean you can't quantify enterprise value because of culture, other than workplace culture. But that's not what you're talking about here. You're talking about actually mobilizing certain sectors of not only just the economy but a non-economy and making them an economy. Talk about that.
Yeah, no, I think you said it exactly right. You know, that's our core thesis. And what we pretty much did is we said, okay, this is not only just not a soft asset, it's a hard, quantifiable asset, and you can build a financial business from it.
So let me just this is because it's a teasable moment. What he's talking about is, look, he's got a proof of concept called Bragg House. In other words, here's my idea and we did it. And he's also scaled it. What you're basically saying is, because you know the recipe on how to do it, you've proven it, and you've scaled it, this is duplicable, correct? This is replicable, correct?
Correct.
So it doesn't just have to be your business. It could be done not necessarily just by you guys, right?
No, exactly right. You know, I think we built a model that can be replicated And I think it should be replicated because I think it really is a way to, I think it's the future. And what we're doing is converting community energy into a financial infrastructure.
See, that explains it perfectly.
Community energy, I love that.
That explains it perfectly because you're taking fans of something. It could be knitting cat sweaters. And you are creating. No, I'm being ridiculous about it. But
you're right. You're right.
But they're there.
But if there's 25,000 people that love that and they're willing to pay you $20 a month, that's $450,000. Okay, so every month. So that. Look at it. We're saying it simply, but it's based on
you
real
guys are
world.
totally right. That's exactly it. That was exactly it.
I always hear the phrase "meet them where they're at." You know, people say that about whatever industry you're in, but that's what you're doing. You're meeting these. Kids, potentially kids, maybe people my age too, depending, but where they're at, they're having fun, they're with their friends, they're loving what they're doing, they're in a good mood. So then they're like, let's spend money.
Here's what I want to know, Levell. When you decided to approach Gen Z with this idea, and it's a fantastic idea, and there's a lot of fantastic ideas, it's all about engagement. How do you get them to adopt your idea? So adoption and engagement used to be called traffic and conversion, right?
Yep.
Back in the day. You drove the traffic, you had to convert them to the next page. Then they had to click the next page, right? Well, there's no more, there's none of that. That doesn't happen anymore.
It's true.
So how do you get past the speed bump of no engagement because it hasn't been thought of yet to the on-ramp to engagement to actual engagement?
So you want my secret sauce?
Yeah. No, you have to tell us completely, but there's a challenge there.
But you're right. It was. And, first we kind of researched to kind of figure out where they were, exactly what you said, Mary, where they were at. And, what we did is that we created a core engagement loop called the BRAG, predictive, non-monetary bets on game outcomes using in-app currencies. We call that BRAG bucks.
Yeah.
The loop
Paper
was
trading.
Yeah, exactly. The loop was the data collection tool. So we embedded these kind of dynamic surveys, ran gamified A/B testing, and what we came up with. So we created the infrastructure first, got them to where they, place where there was their own. That's the authenticity part of it, and then we tried to make sure we understood it. And when you gave them that much, when you gave them what the audience wanted, they'll give you so much more back. So what we were able to build from this was not just, okay, I like this, but we were able to get actionable insights on what they would likely buy, what promotions they would actually respond to, and that proprietary data became something that no one else had, again, because we did the first part right.
What's interesting, Levell Malloy is our guest. He's CEO and co-founder of Bragg House. Their stock symbol TBH. What's interesting is this thing called cultural capital that I think very few people have actually tapped into. You're one of them. But I mean, if you think in terms of deploying cultural capital, not human capital, not IP capital, not supply chain and supply demand capital, but actually cultural capital, because it's just looking at something in a different way, thinking, wait a second.
Yep.
If I get $1 from each one of those people, that's real. That's real. If I can provide them a viable product or service, and get $1 from each one of them, obviously exponentially, the bigger the culture, the bigger the paycheck. But I mean, it comes down to something very, just the way you look at it, right? Like if you look at Steve Forbes, who will, right next to you, two of the most significant interviews I've had, Steve Forbes will say, find a need and fill it. You're going to say, find a culture and do something for it, right?
Exactly.
Can you?
And again, just, I'm sorry, Mary.
No, go ahead.
No, I was saying, and I don't want to shortchange what we did for that. We spent, my background, research and as
well, I'm not suggesting. By the way, I want to be clear. I'm not suggesting you guys just, were overnight success. I mean, look at just because you found the map doesn't mean you even have gas in the car yet. So it takes a lot of work either way. Correct?
Yeah, and what I was going to say, the only thing, and sorry, Mary, I'd love to hear your question. The only thing I was going to say too is one important asset that we did with that was we had a ambassadorship program that at one point it was actually people just wanted to buy that because of the way it just worked so authentically. But we used that to give value and also to make sure we understood, because again, we're creating a product for this audience. So first, step one, understand the audience, period, full stop.
Before we let you out of here, what are you looking forward to most in the next 18 months?
So, there's a lot more involved to this. The simple thing is that, we've done, and you've heard me say this before too, we've done an amazing job of creating these experiences. And now to be able to give not just the Gen Z community, but every community this ownership. And that's something that will come in like real world asset tokenization, which again, there's a lot of moving pieces to that. But to be able to give people who wouldn't normally have control and to have ownership, to give them that's going to be something to see how that plays out and how we direct that and have a bunch of ideas for it. That's going to be really exciting to see that.
I can't wait and to see what you guys do next. And this is the first of a series that we're going to go through. In fact, I think we still have, probably next week, we'll do the second part of this, and then we'll go to the next part of it. Levell, thank you very much, buddy. I appreciate it, man. Get your butt over here. San Diego, you're only 6 hours away. He's got little kids and a wife. I'm just telling him to leave the whole thing for a couple days and come to San Diego.
Come on down.
Big Biz Show continues. Stand by. BizShow.com. We got Dan Negroni in for Mike Costa. He didn't realize he's co-hosting the rest of the show.
There we go.
We are brought to you by Prudential. Let Prudential be your rock for retirement. Also brought to you by Bayer Advanced. Better science, better results. Starbucks Coffee, and of course, Bloomin' Brands and their fine family of restaurants. And last of all, Taylor Guitars. Dan Negroni's in the studio. Couldn't be happier. Of course, CEO, coach, consultant, chief launch officer, professor, and Grandpa Dan.
Yeah.
The youngest looking grandfather, I think, in the history of grandfathers. I remember you talking originally about ChatGPT, and then you entered into a conversation about a thing called Perplexity.
I was showing my muscles about how smart I am.
Pretty good.
Not really.
Flex.
So I have since become addicted to Perplexity. I use Perplexity. It's the right on the front of my phone apps. I use it probably as much as I use text messaging. But I don't understand the difference, and I think your same question, between ChatGPT and Perplexity, or ChatGPT and Claude, or some of the other.
Are they all the same thing?
I think they're all different large language models, but they do essentially the same thing.
Okay.
Claude, Grok, ChatGPT. Those all do the same things. Those are an AI-based thought partner to help you with any problem you might have.
Is it a 1-2 punch though? Like, do you go one, I want to know a recipe to how to make peanut brittle. Do I go to Perplexity and then ChatGPT take that and dig deeper, or how does?
Yeah, I'm by no means an expert on AI specifically, how AI is impacting the workplace for sure. How I've been taught and how I understand and how I use Perplexity is that it is a research tool. It is like Google on steroids.
Sure, right.
Google better watch out for Perplexity. Now, ChatGPT also has this new thing called, I can show you if you drop down it, called agent mode, that does really in-depth research, or better research than Chat does. And gives you all the citations and all that. That's what Perplexity is.
You can ask for it too, though, because sometimes I'm like, can you please make sure to cite your...
Like everything in life, it may not give it to you, but you can ask for it.
I can ask.
Sure.
Does it make sense, as we're going through this, for people to shift from a Google to an AI learning tool like ChatGPT or Perplexity?
It's all what you get comfortable with, right? Whether you use a Safari browser or a Chrome browser.
That's what I was thinking, is the browser days when you could use Yahoo or you could use Bing.
I'm still on Netscape.
But you get comfortable with one, and I'm just like, Google's my go-to. That's what or Chrome or whatever.
For sure. I think, what you guys know from having a business show, AI, the fear of AI replacing jobs is the biggest thing that I hear. And how to teach students, how to teach with it. So students can actually learn how to think, but yet use AI to combine it with a human to be superhuman, but still know how to think, right? Garbage in, garbage out. We've talked about that even when the kids were here.
Yes.
The students, sorry.
No, they're kids. I thought I looked way older than I did in college. Apparently I didn't. You have said, and you say continually, AI is not the threat.
I think AI is a tool that helps you. You have to be very careful about using it and tonality and whether it has your personality, and of course site checking it and make sure it's correct. I mean, you can even ask it. Can
I
you
call it out when it's wrong.
Can you call a deeper dive?
I get mad at it.
Can you do a deeper dive on this particular thing? Yeah, come on, chat. What you doing?
I was like, that actually is
Give
not
me something of value.
Because
because it's not like saving me 4 hours a day is good enough.
Right.
Because there's a certain panic about AI replacing people, just like there was a certain panic about automation replacing people, and so on and so forth.
Well, look at all these layoffs too that are happening, and people are. I just don't think we're comfortable yet with how to use it in a way to really get the most out of it and get the most out of our people. I mean, you got to still teach your people how to use it. You got to give them the tools, and every different industry has so many different things coming at it with AI. Whether you're a manufacturer for supply, if you're a law firm, think about that.
Yeah.
Their job is about research, and yet now you have this tool that can really look at all the cases, do all the research. So you have to be super careful, and ethics as well, too.
Yeah. I think what's interesting here is that many people just default to the fact of students learning through AI and learning through Perplexity and ChatGPT and Claude and everything else, is that it's a lazy man's way, a lazy person's way to get to something that used to have us take hours of research.
Right.
I think if you think of it as an efficiency model,
right.
It's not the same output that we had. We had a certain output based upon what we had in our hands.
The output's way better.
Output's way better, right? Isn't that the idea?
Oh yeah, 100%. I mean, I think it's not about being lazy. It is about being efficient. And when you're efficient, you still have to make sure it's done right, and it serves the need of the listener, the audience, your purposes, all those things.
I'm going to bring up college and my daughter. This is my other daughter who's applying to college.
Who won the
You've got a running tally.
James got the 20.
Bring this up.
We have a little, like Super Bowl box thing. It's how fast Mary's going to bring
up. You put dollars in every time.
Yeah. How fast Mary's going to bring up college and her daughter.
But there's a checkbox on there to say that you didn't use AI. You could use it to supplement and correct grammar and very basic.
But you didn't cut and paste the answer out.
Right, and so you're on your honor. But I did think it was interesting that they make the distinction to say, use it to check your grammar. Like they didn't go ahead and say that, but you can.
Yeah,
and I
you
think
have
that's
Grammarly
saving
and all those
the time,
programs. Yeah.
Right.
Yeah, but again, shouldn't you know correct grammar? Shouldn't you be able to speak correctly?
I do because I'll use it to check
correctly.
my grammar, and then I'll say bold what I did wrong, and then so I can learn my lesson.
But at the same time, because if you do know your grammar and you do know cadence and timbre in terms of communication, I can tell in a New York minute when someone has sent me something that is straight out of AI generated through ChatGPT or otherwise.
True.
You can get better at it, but especially if they have all the emojis and stuff.
Yeah, exactly.
Right, and the font.
Yeah.
Right? Change the font, folks.
Change the font and the
Change
bullets.
the font and the bullets and the little fires and all those things.
Hey, what's next for you in terms of consulting with companies and such like that? I remember Launchbox was a huge success, and you could coach not only corporate executives but also individuals.
Yeah.
Is that still a passion for you?
Of course, yeah. I mean, coaching is something I've done my whole life. I mean, you guys do it too by providing information, and coaching is required now. All these Gen Zs, they don't want you just to, talk to them from the ivory tower and tell them what to do. They want to learn from you. I see it in class when we have guest speakers all the time. They're so much more interested in the life things and the life lessons, and so coaching is about reflection. And so,
I'm looking here. I'm on Perplexity here, and now they got Perplexity Pro, which of course I got sucked into.
Of course.
But and I'm starting to realize here that there's a commerce model there in terms of the AI game on the face forward for consumers. At the same time, though, I think my fear of lazy students, my fear of jobs being taken over, is way overshadowed by the fact that I'm excited that all of this is at our fingertips now, even more than when Google came along.
I mean, think about how much more time you're going to get to do the things you love to.
Oh, absolutely. I mean, it's
music, all of it.
Exactly right.
It's just, it makes it so much more efficient. It saves me at least 2 hours a day.
Will you please bring your classroom back in here?
We need to.
Let's do it once a month. I'm commit to yes once a month.
Yeah.
But I want them to get up here and be part of the show this time.
That'd be fun.
And they should have to ask us questions.
That's good.
Yeah.
DanNegroni.com is his website. Dan Negroni, of course, a regular guest and our expert on almost everything.